Good morning, ladies and gentlemen, and welcome to the show. This is Friday, the 12th of March, 2021. Thank you for tuning in. Listen, I'm glad to have you guys here. Now, here's the thing. Look at this picture. This is a man walking a tightrope. This is what the Federal Reserve is up against. And they've been walking this tightrope for a long time, since 2008 until now. And as they leverage the system with more and more cheap, easy money, it's like it becomes harder and harder for them to maintain this balance between inflation and deflation. Because the more leverage is in the system, the more the system wants to rebound. Actually, it wants to fall toward deflation. They can't let that happen because ultimately a deflation and a deleveraging of the system at this point would completely crash everything. It crashed all of these hyper bubbles. These are not regular bubbles, guys. These are hyper bubbles. All of them. And the bond market is like a windstorm hitting this guy on the tightrope line. And it's going to want to fall toward deflation. And if they lose their balance, the Fed, this precarious balance that they're maintaining, the only way they're going to be able to bring it back is with tremendous amounts of money. And I say money, I'm actually talking about currency. They'll have to create tremendous amounts of currency to bring that balance back if they start to fall toward deflation. Once they lose that center of balance on the tightrope. So, the bond market right now is threatening to push the whole thing off toward deflation by these bond yields rising because it's such a huge market. And we got to watch the 10-year. If the 10-year rises above 2%, really bad things could happen awfully fast. Faster than the Fed can react. And, I don't know if they understand this. Maybe they do understand it. I don't know what's going on in the mind of the Fed. I can't understand. But they need to control these bond yields on the 10-year and all the way on the long end of the yield curve out to the 30-year. They need to keep these yields stable, and the yields are starting to rise again. It's getting nervous out there, and you can see the effect of it in all the markets. Let's get the chart started right here and take a look. We see the effect on silver, down 53 cents today, 25.56. This is the effects of the bond yields rising. Gold, we're seeing it at $17.04, down $18.70. So it's having a very profound effect upon commodities. Bitcoin peaked last night, and now Bitcoin's starting to fall off a little bit too because of this. We're seeing the Bitcoin price, it was up to like 1740 or something, 1740 last night, and now it's down to 1700 even. 1700 billions, that's what I'm talking about. What we're looking at is the Bitcoin is 61.7% of the industry right now. A Bitcoin price of 56,355. So it hasn't fell off as much as gold and silver has. But what's causing it is the bond market. And it's when you see the bond market yields start to rise, you're going to see the dollar go up and up on the DX. Let's take a look now at the Dow Jones Industrial Average. 32,627, and it's up 141 points. But this could actually change in a flash. All the indexes are starting to turn downwards except for the Dow today. This could really change in a flash, if these bond yields continue their upward trend. We're going to take a look at that trend in just a minute here. Let's take a look now at crude oil. Crude oil is feeling it, but it's not down very much. Only 17 cents, or 0.26%, at 65.85. The MOVE index today. We're looking at the MOVE index. We see a steady rise in the MOVE index, and this is as these bond yields been creeping up. And it's following the bond yields almost exactly, the MOVE index. If this move index goes over 75, it indicates instability in the credit markets. I'm going to tell you what, you want instability in the credit markets. You watch that 10-year go over 2%, and you'll see instability. If they let it fall too far, if they let the 10-year slide over 2% for any length of time, the system's going to start to deflate. And, you know, we're seeing the 10-year creeping up toward that mark. Let's get right in there and take a look, and I'll show you guys. Let's get the 10-year up right here on the charts and take a look at what's going on with it. Let's go out to the, let's go out to about 6 months here and take a look how it's been creeping up over the last 6 months toward that 2% mark. And if this keeps going, and you can see this isn't a regular rise in price. It was regular, but it's starting to make like an exponential swoop up. If you can see, like it's getting worse. This isn't getting better. This is getting worse, and it's moving up faster than it was before. It's increasing in its velocity. It really started to take off. My glasses. See here around February, I guess, it really started to take off, you know, in March, and it's really starting to go up really fast now, you know, and they got to step in. They got to step in because this is trying to find about 8%. Yeah, I said that right. It's at 1.6% right now, and it can't go over 2% or it's going to start to bring the system down. But it's not trying to go to 2%. It's trying to go to 8%, 7 or 8%. What it's trying to do is it's trying to get up and find free market value to match the price of inflation. So that investors out there, see, all markets try to find fair market value. But we're living in a world right now where all the markets are controlled. They control the short end of the yield curve. The Fed, they control all the short bonds. They already control those. The overnight rate, they control it very, very rigidly. But this long end here, they're not controlling. And this is the part of the market, the only part of the market right now that's not being controlled by the Fed. And this is the fly in the ointment. And they're starting to lose control over it. They got to take control over it because it's one of the biggest markets out there. This is what all debt's based on. It's based on the U.S. 10-year. That's why I'm making a big deal about it, guys. Is because of the potential of the 10-year, what it can do if it goes too high, over 2%. It can start to crash the system toward deflation, and it can happen so fast. It can happen faster than the Fed can react. So it's time for them to step in now and say, hey, okay, we're going to put a stop to this. We're going to do yield curve control. And the markets will all settle back down again. But if they let this go too far, and this starts to get up toward 2%, or maybe over 2%, the crash will come so suddenly, they will not be able to react to it. The stock market could quite literally fall 5,000 points in a day. In one day. Where they faced with, and they'll be in a panic. They'll be running around like they have their hair on fire if they let this go too far. In fact, it could start to lock up the system in a matter of hours. Everything could just completely fall into deflation. And then what would it take to bring it back? It would take so much money that it would send us spiraling in the opposite direction if they let that happen. In other words, we've been going along for years with the Fed walking this tightrope. Everything remaining relatively stable. But this could make the Fed fall. And then the Fed can't fall. They have to get back on that tightrope at any cost. And the cost would be a creation of all this new credit or debt that they would have to create in order to restabilize the system. And if they have to do that, then what's going to happen is we're going to start to fall toward inflation even faster than we're falling right now. Much faster. In other words, they could bring on the hyperinflation much sooner if they fall off the tightrope and they let this go. You know, this is a really serious situation. I'm like a financial doctor, okay? And this is like a burst appendix. If they let this thing go over. Now, if you guys know about doctors and stuff, you know, in the hospital, if somebody comes in with a burst appendix, it's something you cannot let go, you know, or it'll turn into something called peritonitis. And the system could actually die. And that's the way with this. This is like a burst appendix in the system. And if the Fed lets it go, it'll turn into peritonitis. And the whole system could go down into a massive deflation because it's all ready to pop. There's all these huge monster bubbles ready to pop. And so that's why I'm excited about this. I'm excited about this because they got to do something. And they need to do it before it creeps up. I mean, look at this. If we look at this chart, look at it going up. And it ain't going down, boys, until they do something. And it's heading toward that 2% mark. Yeah. This is serious. This is the market that controls all debt that is weighed on this. And you know why it's going up? Because it's a negative yield. Negative rate of return. Inflation rate right now is far more than this piddly little 1.6%. That means if you buy these treasuries, you're going to lose money. Investors aren't going to lose money, you know, so they want the yield's going to creep higher until they get to the point where they can make a little bit of money. Well, what's that, 6, 7, 8% right now in this kind of environment? And that would be an understatement. Really, to make money on these bonds right now, you'd probably have to have 15%, considering the rate of inflation out there. You know, if it was me, and I was buying one of these bonds, and it was 15% right now, not 1.6%, 15%, I'd take a serious look at that, and I'd say to myself, gee, you know, I know how food prices are going up. I know how rents are going up. I know how utility prices are going up. Look at Texas, for crying out loud. Those poor people got sent a 1-month bill like $10,000 for the utilities. I mean, that's like 10,000% up. You know, I know how prices are going up. So I'd take a look at that 15% per year, and I'd say, will my dollar buy the same as it buys right now a year from now with just 15%, if I just get 15% on my dollar? So if I invest my dollar and I get $1.15 back, will that $1.15 be able to purchase what a dollar will right now 1 year from now? Hell no! You need $1.50 or $2 to break even. And they're going to offer you 1.63%. No wonder the yields are going up. It doesn't surprise me. But it'll crash the system if it goes over 2%. This is the situation we're in right now. This is what we've created for ourselves. You know, and the Fed, actually, you know what? I just shouldn't have even said that. That shouldn't even come out of my mouth. This is what we've created for ourselves. This is what they've created for us without asking our permission. They did it, not us. So I shouldn't have even said that. They've created this situation for us. And now, I mean, we're going to pay the price because they can't let it go up. And right now, they're sitting in a situation where they can't afford to do much about it, really, unless they're pushed. And they're going to be pushed because they're going to be pushed off the tightrope if they don't do something about it. Okay, it's like a burst appendix. You got to do something about it. It's like a person goes into the hospital and they're scared of operations or whatever, and they got a burst appendix. Well, you better get over that fear real quick, and that's what the Fed. You better get over that fear real quick, and you better hit that printing press or do something to bring these yields down. put some sort of program in or something to bring these yields back down again on the long end of the yield curve. And you better do it soon. You can't let this go. This will be pertinitis to the system. Okay, 91.92 on the U.S. dollar index. We see this creeping up in the dollar index today. This has all got to do with the bond yields creeping up higher. You know, it's adding strength to the dollar, and they like that. They're probably sitting back there at the Fed, relaxed as they can be, sipping on their coffee and saying, look how strong our dollar is today. Yeah, these bond yields creeping up are good, eh? Isn't that nice? It's making our dollar stronger. It's holding our dollar in position. It's pushing away the inflationary risk and all this kind of crap. And they won't take a clue until all of a sudden their system starts to spiral into deflation uncontrollably. You know, it might all of a sudden hit the market like the Dow, and they might wake up some morning and Dow's down 2,500 points just one morning and dropping like a stone, and then all of a sudden the panics, the flasher will come on, you know, the red strobe light inside the Fed room, you know, and they'll all be called into an emergency meeting. You know, but they'll never react on this side. On this side, it wouldn't take much to stop this from happening. But they'll wait until it all starts to collapse, and then they'll all run into an emergency meeting. What are we going to do? Well, we got to control these bond yields. Well, how much money is that? Well, now it probably wouldn't take that much money to do it now. Like an ounce of prevention is worth a pound to cure. But they have got their heads in the sand, and they're going to wait until they have to pay the pound before they announce. You know, they're going to wait. Anyway, listen, guys. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.